If you only trade one time frame, you are trading blind in 2 dimensions. The 15-minute chart screams buy while the daily is rolling over into a bear trend. The weekly says accumulation while the hourly looks like the world is ending. Multi-timeframe analysis is how professionals reconcile those stories, find genuine confluence, and time entries with a fraction of the risk. In the next 7 minutes, I will show you the exact framework, the math behind it, where it breaks, and how to apply it on your very next trade. Think of multi-timeframe analysis like navigating with 3 maps. The weekly chart is the continental map. It tells you which country you are in, the dominant trend. The daily is the city map. It shows the neighborhoods of support and resistance. The hourly is the street view, where you actually park the car. You would never plan a road trip using only the street view, and you would never drive to a specific address using only the continental map. Each time frame answers a different question, and you need all 3 to act intelligently. The math is simple but important. Each time frame you use should be roughly 4 to 5 times the next. So if you trade the 1 hour, your context is the 4 hour, and your trigger is the 15-minute. This ratio matters because it keeps each chart structurally independent. Go too close, like 1 hour and 2 hour, and you are just looking at the same noise twice. Go too far, like 1 minute and daily, and your context becomes irrelevant before your trade resolves. Pick 3 timeframes that respect the 4 to 5 multiple, no more. Always work top-down, never bottom-up. Start on the highest time frame and ask one question. What is the trend? Use a 200-period moving average or simply mark the structure of higher highs and higher lows. That answer becomes your bias filter. Drop to the middle time frame and identify the key levels, prior swing points, value areas, the zones where price actually reacts. Finally, drop to the execution time frame and wait for a trigger that aligns with both. If any layer disagrees, you stand aside. Patience here is the entire edge. Here is a clean teaching example. On the daily, price is above a rising 50-period moving average and just bounced off a clear support shelf. That is bias bullish, context by the dip. Now I drop to the 4 hour. Price is consolidating in a tight range right at that daily support. I mark the range high as my trigger level. Finally, on the 1 hour, I wait for breakout candle that closes above the range, with the 1 hour moving average sloping up. Entry is on the break, stop goes under the 4 hour range low, target is the prior daily swing high. 3 time frames, 1 decision. Let us validate this on real price action. On SPY daily over the past year, notice how every meaningful pullback that held the rising 200-day moving average produced a tradable bounce on the lower time frames. The daily defines the regime. When the daily was above its 200-day, dip buys on the hourly worked. When the daily lost that level, the same hourly setups failed repeatedly. Same signal, opposite outcomes, because the higher timeframe context flipped. That is the entire thesis of multi-timeframe analysis in one chart. Confluence is when independent signals across timeframes point the same direction. A daily Fibonacci 61.8 retracement that coincides with a 4-hour prior breakout level that coincides with an hourly bullish engulfing is a high probability cluster. The probabilities are not additive, they are multiplicative. 2 independent signals at 30% edge each combine into a much stronger setup. Your job is not to find more indicators. It is to find more timeframes agreeing on the same price. Divergence becomes far more powerful across timeframes. A daily RSI making lower highs while price makes higher highs is a warning. But if the weekly RSI is also rolling over from overbought, that warning becomes a thesis. Conversely, a 4-hour oversold reading inside a daily uptrend is a buy signal. The same 4-hour oversold inside a daily downtrend is just a pause before the next leg lower. The oscillator did not change, the context did. Multi-timeframe analysis has a real weakness, and it is lag. A weekly candle does not close for 5 days. By the time the higher time frame confirms a reversal, the lower time frame move is often half over. The fix is to read unclosed higher time frame candles as developing information, not gospel. If the weekly is forming a bearish engulfing midweek, weight the bias accordingly, but do not treat it as confirmed until Friday. Otherwise, you will keep arriving late to every turn. 3 pitfalls kill multi-timeframe traders. First, timeframe shopping, flipping charts until one agrees with the trade you already want to take. Pick your 3 timeframes before the session and do not deviate. Second, paralysis, demanding perfect alignment across 5 timeframes, you will never trade. 2 of 3 agreeing is usually enough. Third, mixing apples and oranges, applying the same indicator settings on every timeframe without adjusting for the underlying period. A 14-period RSI on the weekly is a fundamentally different beast than on the 5-minute. To apply this tomorrow, do 3 things. Pick 3 timeframes respecting the 4 to 5 multiple. Define your bias on the highest, your levels on the middle, your trigger on the lowest. Only take trades where at least 2 of the 3 agree, and never trade against the highest timeframe trend without a clear reversal thesis. Multi-timeframe analysis is not magic, it is just disciplined context. This is education, not financial advice. Trade your plan, manage your risk, and I will see you in the next one. If this helped, do me a favor, hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.